Once we have our annual reports with us, we can start calculating our ratios. And the process of ratios is that you need to know the formula which is given in the book, and then you pick the figures from the annual reports, place them in the formula, and calculate the result. So if we start with our first formula, we know that OCC we have calculated in the first week. OCC is inventory days plus receivable days minus payable days. And so we need to calculate these three ratios to be able to calculate OCC. So my first ratio is inventory days, and the formula for that is average inventories divided by cost of sales times 365. So the process is that we locate and extract these numbers. So inventories are my statement of financial position figure. So I'll go to my statement of financial position, which is the second, usually the second statement. So that's the statement we are at. And what we should do is, these are our figures, 706. So we have two figures, one for 2022 and the other one is 2021. Yes?
Sorry.
That's alright.
On the M&S thing that you wrote with the answers and stuff, it says closing inventory divided by cost of sales instead of average inventory.
Yeah. And I explained that why I'm using those figures. Yeah. I used in the previous in the video which is already there, I used closing inventories, and I explained that you don't have to do average inventories all the time, because most of the companies, they keep their closing balances pretty stable for inventories, for receivables, for payables. However, due to pandemic, and we will see this, due to pandemic, these balances are different, so if the balances are different, then we do averages. But if they're pretty much similar, then we don't have to do average. It's a good question. So what I do is I go to my Excel, and I have my 2022 data and 2021 data, and my inventories for 2021 is 706.1, and for 64.6 2021, the total is this much, and then we can take the average by dividing the total by 2. So we have our average figure. Cost of sales. This is a figure from income statement, or profit or loss account, the new name for it. So it's still called consolidated income statement. They're still using the old terminology. And cost of sales should be here, but it's not here. And that's one of the problems you will encounter when trying to locate and extract figures from the statement of financial positions, or financial statements. So what we need to do, we need to go and look into note 2 and 3 to see if we can find that figure there. And we will have to do this looking into the notes. So this is my note 2, which is segmental reporting. It explains how did we make all the sales. So that could be useful for receivable days, which we will come back to. And here it is, my figure for cost of sales are given here, 7130.3. I have all the data now, and I can put that in my formula. So what I do is average inventories 665.35 divided by 7130.3 times 365 days, and if I use the bracket, I can do it in one step. Divided by times 365, and my days are 34 days. Few other things which can help us to understand this ratio a bit more is, number one, if you look at the percentage change between 22 and 21, you see that it's 81.5. So if you do a percentage change divided by base year, 2021 is the base year. Earlier year is always the base year. Our percentage increase in the inventories is 13%. If you go back to that video, which I recorded for 2015, 2017, 2016, 17, 18, you'll see that percentage change is less than 5%. So there's a significant change in inventories, and that's why we had to do average inventories. Otherwise, I wouldn't bother with the average inventories. So inventories have increased by 13%. When you're explaining working capital management, this is a very good point. And then you can look into research into the reasons for increase in inventories. Normally, increase in inventories is not a good sign. So look into it, read a bit, and then you can decide. So one of the reasons I did this is to calculate, do I need average inventories? Yes, I needed average inventories. So this 13% is a significant change. 34 days, this is, it takes 34 days for M&S to sell their inventories, and I think this is really good. 34 days is really good, especially if you look into the supply chain of M&S. Obviously, they sell lots of clothing. Obviously, food should be sold very quickly. So Tesco primarily sells food. They have their inventory days around 29-30 days. They are 34 days, but they sell lots of clothing. So they buy wool and cotton when it is harvested, and then it is stored in the warehouses, and then it is processed, and then whole process of stitching, cutting clothes, stitching, and then getting shipped from wherever they're manufacturing, and then displaying it on the shop floors. So 34 days is a brilliant result when it comes to inventory management. The second ratio which we need to calculate is receivable days, and for M&S this ratio is very confusing. So, and more, it should be trade. Can I have somebody? Somebody's asking a question, I think, a bit. Can you be a bit more louder, please? Trade receivable days, average trade receivables divided by credit sales times 365. That's the formula. So if you look at the data here for receivables, for my 2022 receivables, going to my SOFP, here it is, my trade and other receivables, folks, 217.1 and 209.6. This is the data, and this is the figures for trade and other receivables. Trade receivables are our customers who buy from us on credit, and other receivables are people who may have to pay us for some other reason. For example, the bank owe us some interest on the money we have in the bank. That is our other interest receivable. So there are other receivables, but the formula requires only trade receivables. So what we need to do, we need to go into the note 17 and look at the figure for trade receivables. Figures are given in two different areas, non-current and current. So we'll pick figure from trade receivables from current, 103 and 109.8. 103 and 109.8. Percentage difference. How much is percentage change divided by base year? 6%. Some would say it's not significant. Some would say it's significant. It's quite a subjective thing. So they do have change. So these are my, what are the averages? Okay, let's do the averages. Opening plus closing, and if you do it divided by 2, we have our average figure for the formula, so we can place it in the equation. Credit sales. For 2022, this is the most controversial figure for M&S. For some businesses, it's not a problem, but the formula requires credit sales. And do M&S sell on credit? If you go to them, would they sell you on credit? No, they don't. Retailers, Tesco, Sainsbury, almost all of their sales are on cash. So they don't. So then this, if this is so, then why do they have receivables? Trade receivables more specifically. If they have trade receivables, then they do sell credit on credit. Otherwise they would not have trade receivables. But who do they sell to? Now, you can find out, maybe you can find this out by reading their annual reports in a bit more detail, by looking at CEO statement and relevant notes. But the reality is, they don't tell us who do they sell on credit. And the chances are, these are maybe some franchisees or whatever. We don't really know. So there are a few points to be noted when you're calculating trade receivable ratio for a retailer who sells on cash. You cannot, point number one is, you cannot calculate this ratio accurately. Whatever you do is going to be inaccurate because we don't have access to the correct data. Point number two, that this ratio is insignificant for the businesses who do not sell on credit. Okay? It's insignificant. So it's going to have a very little impact on their OCC because it's so small. The third thing is, in the absence of any data, you're going to have to use the revenue figure, whatever we have, and we will use that. So you cannot calculate it correctly. It is insignificant, so even if you don't calculate it, it does not matter. It does not have an impact on OCC. It does not have an impact on your understanding of how OCC is being managed in that business. And number 3 is you're going to have to assume all sales are credit. Incorrect assumption, but we don't have any other way to deal with it. Okay? So, if you do the third one, and it'll get slightly more interesting in a minute, we need to take all of the revenue figure. So we go back to our income statement, and my revenue figure is 1085.1 mil. So what I do is 1085.1 mil, and I do this analysis which I'm doing for other, and first thing I'll do is a percentage of receivables or debtors of revenues, and this is 1%. So these receivables are 1% of the total revenues. That shows they are not material, not significant. So that's another reason or another justification for not even calculating this ratio. If you don't calculate this ratio for a retailer who sells only on cash, it's fine. Okay, no penalty, but you need to understand things. Okay, things which I'm explaining, you need to understand. So it's only 1%. So these receivables are so insignificant that if they are being mismanaged, the chances are they will not have a major impact on an OCC of the company. I give you a comparison so that the things get a bit more clearer, okay? And for comparison, I choose a company which is a manufacturer and only sells on credit. So that business is Britwick. Annual reports, financial statements. What we're looking for is a revenue figure 1618.3 for 2022. So I make a note here, okay? I'm just explaining this something, that how significant receivables could be in a business which is selling on credit. So Britwick 2022 data, my sales are $1618.3 mil, and my receivables trade going to, why is this getting open again? My statement of financial position, current assets, trade and other receivables, note 17 again. So if I go to my note 17, I'm just trying to prove a point here. It's not linked with our calculation, but my trade receivable for 2022 are 399. If you take the percentage, my receivables are 25% of my total sales. That's how significant your receivables are when you're selling on credit. The comparison is 25% of the total revenue in Britwick with 1% of the total revenue in MRS. So this is the significance game, okay? If they're important, you have to look into them. You have to research. You need to manage them properly. If they're insignificant, especially from analysis point of view, obviously from money management point of view, there is going to be a credit controller in M&S who will be looking after their receivables. But we are analyzing company's performance in OCC, and we are trying to figure out how they manage the OCC. And when something is less significant, it always have less impact on our analysis. Okay, so this is an example. For Britvic, receivables are extremely important. Okay, they need to be managed properly. But for M&S, they're so small that analysts could ignore those figures. Okay, so that's what I'm trying to say. So if you have a retailer, and you all would have a retailer, you should calculate this figure, assuming all sales are credit. But when you are analyzing it, when you're writing it down, you need to clarify those three things. You know what, which I mentioned. It is an incorrect figure. It's not relevant. You assume all sales are credit, which is not correct, and then make points assuming. So if you calculate this ratio for M&S, (106) credit sales or sales are credit, assumption, big assumption, times 365, my calculation is 3 days. This is incorrect. Okay, this should be a divide sign. There we go. Four days. So it takes M&S 4 days to collect money from their receivables, which is not correct. But the weighted, comparative weighted wise, it's correct. It may take them 30 days to collect money from their credit customers who maybe are on their store card. You know, when you have a store card M&S, you can buy now and then they'll send you a statement and then you will have to pay that. So these are, I think, those customers. But they are so insignificant, not a massive issue from OCC management point of view, okay? The final is our trade payable days. I need trade payables divided by my credit purchases times 365. So trade payables for 2022 is a SOFP item. My liabilities, current liabilities, trade and other payables, page 19. So you're going to have to go to note 19. Okay, there we are. We have trade payables current 732.8. $732.8. Credit purchases are never given in the financial statements. For all companies, even for retailers, all of your companies, all the companies registered, around 700 companies registered on London Stock Exchange, you can assume all of the purchases are on credit because they're big companies, they can buy on credit. That's how business works. The problem is none of those businesses would tell you actually purchases figure in the financial statements. Not given, never given. Instead, they would give you cost of sales figure. From cost of sales figure, so COS, cost of sales, equals opening inventory plus purchases minus closing. You learned this equation for income statement in, I think, for your previous financial accounting module. So If we change this equation to find purchases, we will be left with purchases equal cost of sales minus opening inventory plus closing inventory. So equation has changed slightly. So we can calculate purchases now. Cost of sales figure we have already used 7130.3 plus closing inventory. We have already used closing 706.1 minus opening 624.6 7211.8. So I got my credit purchases as well. 732.8 and 624.8. The total and then the average 678.8. The percentage change we have been doing for all of the figures, so let's do it for payables as well. Base year 17%, 13%. So the payables change by 17%. And if we calculate our ratio, $678.8 divided by credit purchases, $34 days again. OCC for M&S guys is 34 plus 4 minus 34. And that is 4 days. Obviously, this figure is kind of incorrect because this 4 itself is not a correct figure. But there's no way for us to do it. When you do this for manufacturers, you would know for sure how much is their receivable days. For example, Britwick or Coke or any other Boeing or Airbus or GSK, whatever the manufacturers are, their receivable would be correct.